What if I told you that the academic foundation of your MBA program actually considers active day-to-day portfolio management to be mathematically indistinguishable from, like, pulling the lever on a slot machine in Vegas?
It's a stunning perspective, right? We're so conditioned to view rapid fire trading as this pinnacle of financial sophistication.
Oh, absolutely. It's idolized on all the financial news network.
Exactly. Yet the core orthodox frameworks of finance, they look at those behaviors and just bluntly categorize them as speculation, emotion, and yeah, gambling.
It totally flips the script.
Yeah.
And, well, that is exactly what we're here to do. Welcome to today's deep dive. I know exactly who is listening right now. You are an MBA student. You're gearing up for your exams. You probably have notes scattered literally everywhere, and you're staring down the immense foundational principles of security analysis and portfolio management.
Yeah, you're looking at the actual mechanics of how the financial world operates, and it's a dense labyrinth of information.
So dense.
It's the bedrock of everything else you're going to learn in your program. But if you approach it simply as, like, a vocabulary list to be memorized, you're going to miss the entire architecture.
That's the crucial point. Our mission today is not to just rattle off academic definitions. You have the textbook for that. Our goal is to decode the mechanisms. We want to completely unpack the why and the how behind these concepts.
Because we want to ensure that when you're sitting in that exam hall, or honestly, better yet, when you're in a boardroom 5 years from now, you aren't just trying to, like, recall some matrix. You actually understand the underlying logic of the financial engine.
Right. We're going to trace the life cycle of capital from the absolute atomic level of a single security all the way up to the macroeconomic flows of an entire nation, and then finally down into the psychological quirks of the individual investor.
We're taking the abstract theories and grounding them in the reality of the markets. Because, once you understand the physical forces driving these theories, the exam questions basically answer themselves.
Okay, let's unpack this. We need to start at the molecular level, the absolute base unit of finance, the security. So the fundamental framework defines a security as an asset with some financial value that is tradable and fungible.
And fungibility is a concept we should probably anchor real quick. It simply means perfect interchangeability.
Right, like a dollar bill.
Exactly like a dollar bill. If you hold one share of a company's common stock, it represents the exact same fractional ownership, the exact same voting rights, and the same dividend claim as any other share of that same class. It doesn't matter which specific share you own. They're identical.
That makes perfect sense. But then, to fully define what a security actually is, we are inevitably confronted with the Securities Exchange Act of 1934. And I have to be honest here, as a professional trying to synthesize this, the legal definition provided by that act is a complete nightmare.
Oh, it's brutal.
It's essentially a massive, exhaustive run-on sentence. I mean, it lists any note, stock, treasury, bond, debenture, certificate of interest, participation in profit-sharing agreements, oil, gas, or mineral royalties, and it just keeps going.
Yeah.
It talks about straddles, voting trust certificates, foreign currency. If I'm an MBA student looking at this, my immediate reaction is panic.
Yeah.
Like, how am I supposed to logically compress a legal dictionary for an exam?
Well, that panic is completely understandable, but it's also easily cured if we understand the historical context. You have to remember the 1934 Act was drafted by lawmakers who were absolutely reeling from the devastating crash of 1929.
Right, they're terrified.
They were terrified, and they were trying to close every single loophole imaginable. They wanted to ensure that no clever financier could, invent a brand new financial product, sell it to the public, and then claim, oh, technically this isn't a security, so we don't have to follow your regulations.
So they just cast the widest net possible.
Exactly. But for your operational understanding, and certainly for your exam, you do not need to memorize that exhaustive list. You need to synthesize the intent behind it.
Okay, so what is the synthesis? How do we compress that massive net into a framework you can actually use on a test?
You compress it by looking for 3 fundamental traits. Whenever you are presented with a financial instrument, ask yourself, does this instrument offer evidence of debt? Does it offer evidence of equity? Or does it constitute an investment contract?
Evidence of debt, evidence of equity, or an investment contract.
Right. If you can categorize a financial asset into one of those 3 buckets, you have correctly identified it as a security. The foundational orthodoxy really just boils it down to an investment instrument that offers evidence of debt or equity.
That immediately takes the pressure off rote memorization and, replaces it with logic. And that framework leads us perfectly into the 3 primary categories of securities that dominate the markets: debt securities, equity securities and derivatives.
Let's examine the mechanics of each, because the subtle distinctions between them are exactly what your advanced coursework will test you on.
Let's start with debt securities. These are tradable assets that are defined by having exceptionally clear terms and conditions. We're talking about instruments where the interest rate, the principal amount, the maturity date, and the rate of returns are all explicitly stated upfront.
And the operative phrase you just used is explicitly stated. There is absolutely no ambiguity in a pure debt security.
Not at all.
Right. When you purchase a bond, which is, the classic debt security, you are acting as a lender, you know exactly how much capital you are extending, you know the exact schedule of interest payments, which are often called coupons, and you know the exact date the borrower is legally obligated to return your principal. It's a mathematical certainty. Well, assuming the borrower doesn't default.
Right. Now, contrast that with equity securities. The framework defines these as financial instruments signifying the ownership of an individual in an organization. When you buy equities, you are buying direct participation in the company's profits and its underlying assets.
Exactly. You are no longer a lender, you are an owner. And ownership fundamentally changes your risk profile. There is no guaranteed interest rate here. There's no guaranteed maturity date where you get your money back.
It's all variable.
Entirely. If the company develops a revolutionary new product and profits soar, your piece of the pie grows exponentially. You have infinite upside. But if the company goes bankrupt, the debt holders get paid back first from the liquidation of assets. You, as the equity holder, are at the very bottom of the capital structure. You absorb the absolute maximum downside.
And then we arrive at derivatives. This category is defined somewhat broadly as financial instruments with specific conditions under which payments need to be made between two parties.
Derivatives are fascinating because they don't actually possess intrinsic value in the traditional sense. Their value is, well, as the name implies, derived from the performance of an underlying entity.
Like what kind of entity?
That entity could be an asset like a stock or an index or even something like an interest rate or the weather.
Okay, I was trying to formulate a mental model to lock these three categories into memory, and I came up with a neighborhood real estate analogy. Let me run this by you and see if the mechanics hold up.
Let's hear it.
Let's say you want to expose your capital to the housing market. Debt is equivalent to the bank issuing a mortgage on a specific house. The terms are ironclad. The bank knows their interest rate, and honestly, the bank does not care if that house doubles in value over the next 10 years. They don't get a share of that appreciation. Conversely, if the housing market dips 10%, the bank still expects their fixed monthly payment. Their return is clearly defined and capped.
Yes, and more importantly for the exam, if the homeowner defaults, the bank has a primary lien. They can foreclose and reclaim the asset to make themselves whole. Their principal is highly secured.
Right, they get paid first. Now, equity is the person who actually holds the deed to the house. You have true ownership. If a massive tech company builds a new headquarters down the street and property values in your neighborhood skyrocket, you capture 100% of that upside. The bank's mortgage doesn't change, but your equity explodes.
But the flip side is true too.
Exactly. If the foundation cracks and the roof caves in, you absorb that total loss. You own the assets, but you also own the liability of failure.
That maps perfectly. The equity holder takes the residual risk and the residual reward.
And finally, a derivative is like you and your neighbor standing across the street, looking at that house and drafting a side contract. You say, hey, I will pay you $10,000 if the value of that house drops below a certain price by next December. If it stays above that price, you pay me $1,000 a month until then. Neither of you owns the house. Neither of you lent money to buy the house. You have simply created a financial instrument with specific conditions for payment based entirely on the price movement of an underlying asset.
That is an exceptional visualization of the mechanics. Debt is the fixed loan, equity is the tangible ownership, and the derivative is the conditional side bet based on the behavior of the asset. If you can, keep that real estate analogy running in the background of your mind, you will effortlessly be able to categorize any financial product on a multiple choice exam.
Perfect. So we've identified the security. We know what it is. The immediate next step is figuring out what it's worth. The entire discipline of security analysis is dedicated to calculating the value of these assets and understanding how market fluctuations impact that value.
Because price and value are very rarely the exact same thing.
Right.
A stock might be trading at $50 today, but its actual intrinsic value based on its future cash flows might be $80, or it might be $20. Security analysis is the toolkit you use to find that discrepancy.
And the foundational models give us three distinct lenses or methodologies for conducting this analysis: fundamental analysis, technical analysis, and quantitative analysis. These sound related, but they represent entirely different philosophies of how markets work.
They really do.
Let's dive into fundamental analysis first. The framework describes this as evaluating securities using fundamental business factors. It means scrutinizing financial statements, evaluating current interest rates, analyzing competitors' products, and understanding the broader financial market.
When you're performing fundamental analysis, you are essentially acting as a prospective business owner. You're rolling up your sleeves and looking under the hood of the corporation. You pull the balance sheet to see how much debt they have. You pull the income statement to analyze their profit margins. You listen to earnings calls to gauge the competence of the CEO.
It's very grounded in reality.
Exactly. You study the macroeconomic environment, like those interest rates you mentioned, to see if the cost of capital is going to hurt their expansion plans. You're attempting to calculate the objective intrinsic health of the enterprise.
It's deeply qualitative and deeply rooted in the physical reality of the business.
But then we pivot to technical analysis. And this is a complete paradigm shift. The methodology here relies on forecasting future price trends purely through the examination of past price trends and market data.
Yes, and this is where the philosophical divide really occurs. The pure technical analyst, they do not care about the competitor's new product line. They might not even know what the company actually manufactures.
Wait, really? They might not even know what the company makes. I mean, literally. Their entire worldview is built on the premise that all fundamental information, every earnings report, every macroeconomic shift, every single rumor is immediately and perfectly priced into the stock by the market. Therefore, the only actionable data left is the psychological behavior of the market itself.
They're looking at the chart, not the company.
Exactly. They're studying historical price movements, trading volume, moving averages, resistance levels. They are looking for patterns of human behavior. Fear and greed, right? Those repeat over time. If a stock has bounced off a certain price point 3 times in the past year, the technical analyst assumes there is psychological support at that level, and they make their forecasting decision based entirely on that graphical pattern.
So fundamental is analyzing the engine of the business, while technical is analyzing the psychology of the crowd trading the stock.
That is the perfect distinction for your notes.
And the third lens is quantitative analysis. The description in the text here is a bit sparse, honestly. It simply states that it refers to analyzing securities using quantitative data. But clearly there is more to it than just that.
There is a lot more. Quantitative analysis is the application of advanced mathematical and statistical modeling to the financial markets. The quant takes massive, overwhelming data sets, which can actually include both fundamental data like earnings yields and technical data like price momentum, and feeds them into complex algorithms.
So it's heavily reliant on computing power.
Entirely. They aren't reading the balance sheet manually, and they aren't looking at charts with their eyes. They're writing code to identify microscopic pricing anomalies or statistical correlations across thousands of securities simultaneously.
Okay, so for the purpose of a practical application or an exam question, if the scenario involves forecasting via historical charts and volume, it's technical. If it involves dissecting income statements and market share, it's fundamental. And if it involves algorithmic modeling of massive data sets, it's quantitative.
Precisely. You need to be able to identify the specific tools each analyst uses.
Now that we have isolated the fundamental atom of finance, the single security, and we know how to value it, we face the reality of the market. Because in the real world, no institution or serious investor simply analyzes one single security, buys it, and then goes to sleep. They build intricate networks of these assets. So how do these individual atoms interact when they collide and combine? That brings us to the architecture of portfolio management.
We're moving from analyzing a single brick to designing the entire skyscraper.
I love that. So the overarching definition of portfolio management is that it is the art and science of making decisions about investment mix and policy. It's about matching investments to objectives, optimizing asset allocation for individuals or institutions, and crucially, balancing risk against performance.
I always appreciate that the textbook defines it as both an art and a science. The science is the quantitative analysis of the asset, sure, but the art is the deeply qualitative process of understanding the human being or the institution whose capital you're actually managing.
Because everyone is different.
Right. A portfolio that is mathematically perfect for a 25-year-old tech entrepreneur is a mathematically catastrophic portfolio for a 70-year-old retiree living on a fixed pension.
To navigate that art and science, the established framework mandates that every portfolio manager must constantly answer three critical questions.
Mm.
And I want to emphasize these to the listener because anytime financial orthodoxy distills an entire discipline down to three questions, it is paramount that you internalize them for the exam. They are, number one, where to invest, number two, when to invest, and number three, how much to invest.
They sound deceptively simple, don't they? Almost rudimentary. But let's look at the staggering complexity hidden inside each one. Where to invest. That is the entire universe of asset allocation. Are we allocating capital to domestic equities, emerging market debt, real estate investment trusts, or commodities?
Right, there are millions of options.
Millions. Then, when to invest. That forces you to engage with market timing, business cycle analysis, and macroeconomic forecasting. Are we entering a recessionary environment where defensive assets are required? And finally, how much to invest? That is the rigorous discipline of position sizing and risk tolerance.
Because if you put everything into one stock, you're in trouble.
Exactly. If you put 60% of the capital into one highly volatile asset, you haven't built a portfolio. You've made a massive concentrated wager. A successful portfolio manager systematically answers those three questions every single day.
Before we get into the mechanical tools used to build the portfolio, there is a very important historical and theoretical distinction that is often tested. It's the evolution from traditional security analysis to modern security analysis.
Oh, this represents a massive paradigm shift in academic finance.
The framework states that in the traditional form of security analysis, the primary emphasis was placed on understanding the basic risk-return relationship. And, importantly, the effect of personal needs, desires, and wants formed the basis of portfolio selection.
Traditional analysis was highly subjective. It was very relationship-driven. You can picture it, right? A broker would sit down in a mahogany-paneled office with a client, discuss their life goals, their vague fears about the market, their personal desires for income, and then manually construct a portfolio of stocks and bonds that just intuitively felt right to satisfy those emotional and financial needs. It was very qualitative.
But then we shift to modern security analysis, and the language changes dramatically. It states that intrinsic value is given far more significance, and the primary emphasis is laid on a highly scientific approach in terms of estimating the risk and return of a portfolio and mathematically quantifying the risk-return trade-off.
This is where finance became heavily mathematical. This shift introduced concepts like the capital asset pricing model and modern portfolio theory. The modern approach dictates that you don't just build a portfolio based on a client's vague desires. You utilize statistical variance, covariance, and standard deviation to mathematically construct what is called an efficient frontier.
It sounds so much colder.
It is. You are scientifically attempting to extract the absolute maximum amount of expected return for a precisely quantified unit of risk. The shift was away from the subjective intuition of the manager directly to the objective mathematics of the market.
That distinction is crucial. Now, how are these modern portfolios actually piloted in the real world? The framework presents us with several dichotomies. The most heavily debated, and frankly the most fascinating, is the divide between active and passive investment management. There is a deep structural comparison provided in the text, evaluating them across four distinct areas: results and performance, strategies, taxes and turnover, and analytical methods. Let's break this down mechanistically.
It's perhaps the most important debate in modern finance. Let's start with their core objectives regarding results and performance.
Active investment management explicitly aims for above-average performance. The entire goal is to actively outsmart and outperform a benchmark index, like the S&P 500. Passive management, conversely, is explicitly designed to achieve merely average performance. It creates a fixed portfolio designed to simply mirror and match the current market scenario.
And that exposes the fundamental philosophical divide we discussed earlier. The active manager operates on the premise that the market is inefficient, that other investors are making mistakes. And through superior intellect, better models, or just harder work, the active manager can exploit those mistakes to generate excess returns.
They think they can beat the crowd.
Right. The passive manager, on the other hand, operates on the premise that the market is highly efficient. They believe that millions of participants constantly trading ensures that prices are generally correct, making it virtually impossible to consistently beat the market over the long term. So the passive manager decides to just own the entire market and ride the broader economic wave.
Which directly dictates the second area of comparison: strategies. Active management requires short-term, quick and inherently more risky decisions because you're constantly trying to anticipate the next move.
Yeah.
Passive management relies on long-term positions and slow, deliberate decisions.
Yes, and those differing strategies trigger a massive mechanical consequence in the third area, taxes and turnover.
Right. Because active managers are trying to capitalize on short-term market inefficiencies, they are constantly buying and selling assets. This creates a high turnover rate in the portfolio. And in the real world, every time you sell an asset for a profit, you trigger a taxable event. The framework explicitly notes that this generates high taxes. Passive managers buy a broad index and essentially hold it forever, resulting in a tiny turnover rate and, consequently, low taxes.
This is a mechanical drag on performance that many novice investors just fail to grasp. An active manager might actually succeed in beating the market by 2% gross. But if their high turnover strategy generates 3% in transaction costs and short-term capital gains taxes, their net return to the investor actually underperforms the passive index.
Wow, so the friction of the strategy literally destroys the alpha.
Exactly.
That leads us to the fourth area, analytical methods, and this is where the academic framework basically drops a bomb. I mentioned this in the hook of the episode because the language used is staggering. For passive management, it lists analytical methods like quantitative models, long-term statistical analysis, fundamental analysis, and rigorous risk management. It sounds incredibly grounded and scientific.
It aligns perfectly with the scientific approach of modern security analysis we just outlined.
But look at the descriptors used for the analytical methods driving active investment management. It lists qualitative assessments, emotions, intuition, forecasts, speculation, and gambling. I mean, it literally links the attempt to actively beat the market with speculation and gambling.
It is a profoundly blunt stance for an academic framework to take, but it reveals a deep-seated perspective in modern financial theory. The argument here is that because short-term market movements are essentially random noise, any manager attempting to actively trade in and out of the market based on short-term forecasts is not relying on fundamental business analysis. They are relying on intuition and guessing.
And guessing is gambling.
Right. If you're guessing the direction of a random walk, you are no longer investing. You are gambling.
Whether a listener personally agrees with that, and there are certainly legendary active managers who would fiercely debate it, it's vital to understand that this is how the orthodox academic framework categorizes it. If you're taking an exam, you must associate active management with forecasting, intuition, and speculation, and passive management with statistical analysis and risk management.
Yeah, you have to master the rules of the game as they're written before you can critique them.
There is one more operational dichotomy to cover regarding how portfolios are managed: discretionary versus non-discretionary services. This is simply about who actually has their hands on the controls.
Exactly. In a discretionary portfolio management setup, the client authorizes the professional manager to handle everything. The manager has the legal right to make all trading decisions, execute the transactions, and manage the administrative paperwork without consulting the client first. The manager is the pilot in command.
In a non-discretionary setup, the manager acts purely as an advisor. They perform the analysis and recommend that a certain stock is a strong buy, but the client retains the absolute right to execute or reject that advice. The manager is the navigator, but the client is flying the plane.
It's a straightforward compliance and operational distinction, but definitely an important one to know for the test.
All right, we understand the management philosophies. Now let's open the toolkit. What are the actual mechanical levers a portfolio manager pulls to construct this architecture? The framework gives us the three elements of portfolio management: asset allocation, diversification, and rebalancing. Let's look at the mechanics of each.
Asset allocation is the foundation upon which everything else is built. It's defined as determining the long-term mix of major asset classes like equities, fixed income bonds, and cash equivalents. The underlying mathematical philosophy here is correlation.
Meaning how they move in relation to each other.
Exactly. Different types of assets do not move in perfect unison. When the economy is booming, equities generally surge while safe haven bonds might stagnate. When a recession hits, equities plummet, but government bonds often rally as investors flee to safety. By blending these non-correlated assets, you optimize the overall risk and return profile of the entire portfolio.
You're intentionally combining things that behave differently under pressure. And then we have diversification. The framework provides a very humbling quote here. The only certainty in investing is it is impossible to consistently predict the winners and losers. Therefore, the prudent mathematical approach is to create a basket of investments providing broad exposure.
Think of it this way. Asset allocation is the macro decision deciding that 60% of your money goes into stocks and 40% into bonds. Diversification is the micro decision figuring out which specific stocks to put in that 60% bucket.
So you wouldn't just buy Apple, Microsoft, and Google.
Right, you don't just buy 5 massive technology companies. That isn't diversified. If the tech sector faces regulatory crackdowns, your entire equity allocation crashes. True diversification means buying a technology stock, a consumer staples company, an energy producer, and an emerging market index. You spread the idiosyncratic risk of individual companies across different sectors and geographies because, as the quote says, predicting the single ultimate winner is impossible.
The final element is rebalancing or restructuring, and this is vital because markets are dynamic.
Yeah.
A portfolio never stays static. Rebalancing is the mechanical process of returning a portfolio to its original target asset allocation at regular intervals to ensure it continues to reflect the investor's intended risk profile.
Let's walk through a highly detailed hypothetical scenario to show exactly why this is so critical, both mathematically and psychologically. Let's say you and your advisor determine your optimal risk profile is 70% equities and 30% bonds. You build the portfolio exactly to that specification. Then the stock market goes on a massive multi-year bull run. Your equities double in value, while your bonds just slowly accrue basic interest.
So the sheer growth of the stocks means they now take up a much larger piece of the total pie,
Exactly. Without you making a single trade, your portfolio has naturally drifted. It might now be 85% equities and only 15% bonds.
which means your risk profile has completely changed. You are suddenly exposed to way more volatility than you originally signed up for. If the market crashes tomorrow, the damage will be far more severe than your 70-30 plan accounted for.
Precisely. You are carrying unauthorized risk, so you must rebalance. And here is the beautiful, somewhat counterintuitive mechanism of rebalancing. To get back to 70-30, you are forced to sell off a portion of your equities, the assets that have been performing brilliantly, and you use that cash to buy more bonds, the assets that have been underperforming.
Psychologically, that is incredibly difficult for a human being to do. I mean, you want to let your winners run. You don't want to sell the hot stock to buy boring barns.
It's agonizingly difficult. But mechanically, what does it force you to do? It forces a disciplined strategy of selling high and buying low. You lock in the massive gains from the overheated equity market, and you purchase fixed income assets when they are relatively cheap. It removes human emotion from the equation and rigorously enforces your risk management policy.
Sell high, buy low, mechanically enforced. That makes perfect sense. So we have the tools. How do we string them together into an operational workflow? The academic framework codifies this into the 6-step investment process. Let's trace a dollar through these 6 chronological steps to lock them into our conceptual memory.
It's a highly logical progression. Step 1 is framing the investment policy. Before a single dollar is deployed, you must establish the architecture. What is the objective? What is the total quantum of investment available? What are the required attributes of the assets we need? And how broadly will we allocate the wealth? You are basically drawing the blueprint.
Got it. Step 2 is valuation of investment. You begin analyzing the universe of assets to determine their intrinsic worth.
Step 3 is broad investment analysis, which is essentially gathering all the necessary data.
Step 4 is where it gets very specific. It calls for the analysis of the economy, the industry, and the company where the investment is to be made.
Notice the deliberate sequence there. Economy, then industry, then company. That is a classic top-down analytical approach. You don't start by analyzing a microchip manufacturer. You start by analyzing the global macro economy. Like, are we entering a period of global expansion? If yes, which industries benefit most? Oh, the semiconductor industry. If the industry looks strong, then you finally drill down to analyze the specific microchip company.
Step 5 is quantitative analysis of the investment. You run the statistical models to ensure the risk-return metrics align with the policy you framed in Step 1.
And finally, Step 6 is portfolio construction and feedback. You actually execute the trades and build the portfolio. But the key word here is feedback. This isn't a linear path that ends. It's a continuous loop. You monitor the performance, you gather feedback on how the assets are behaving, and that data feeds directly back into Step 1.
Oh, so it updates dynamically.
Right. If your life circumstances change or the macroeconomic environment fundamentally shifts, you revise the policy and start the process over again. Policy, valuation, analysis, economy industry company, quantitative modeling, construction, and feedback.
We have successfully decoded the security, and we have built the portfolio. But to truly grasp the nature of finance at a professional level, we have to zoom out. We have to look at the engine that generates these securities in the first place. We need to transition to the macro view: investment, financing, and the economic engine.
Because portfolios don't exist in a vacuum. They're deeply integrated into the physical flow of capital across the globe.
The framework explicitly contrasts the act of investing with the act of financing and uses that contrast to explain corporate finance. Let's start with the investor's side. The core definition provided is that investing activities involve employing money with the goal of enhancing future wealth. The critical mechanism is that the investor is taking funds from savings, from owned assets, or even borrowed money and committing them today.
The essential economic concept here is the deferral of consumption. It's really about the time preference of money. When you earn a dollar, you have a choice. You can consume it today, buy a coffee, buy a car, take a vacation, or you can forego that current consumption and invest the dollar.
So you're trading today for tomorrow.
Exactly. By sacrificing utility today and exposing that dollar to risk and time, you expect to enhance your future consumption possibilities. You put off buying a small car today so you can generate enough return to buy a luxury car in 10 years.
That is the motivation of the investor. But where does that deferred dollar actually go? It flows to entities that have a deficit of capital and need financing to grow. And this is the domain of corporate finance. The framework outlines 4 massive structural issues that corporate finance manages.
Let's look at how the corporation absorbs and utilizes the investor's deferred capital.
The first issue is capital structure. This is long-term financing. The corporation has to decide whether it's better to issue long-term equity selling ownership shares to investors or long-term debt issuing bonds to investors, given the current macroeconomic environment. The second issue is project analysis. Once they raise that capital, they must rigorously analyze whether building a new factory or acquiring a competitor will generate a return higher than the cost of the capital they just raised.
The third issue is current asset management, often referred to as working capital management. This is the granular day-to-day survival of the firm. It's managing the short-term cash flows, the inventory levels, and the accounts receivable to ensure the company doesn't run out of cash while it waits for its long-term projects to actually pay off.
And the fourth issue is allocating profit. If the projects succeed and generate revenue, corporate finance must decide how to distribute that new wealth. How much goes back to the equity investors as dividends? How much is owed to the government as taxes? And how much is retained as earnings to fund the next wave of projects?
This creates a perfect symbiotic loop. Investors want to grow their deferred wealth, and corporations need that wealth to fund massive projects. The financial markets, the stock exchanges, the bond markets are simply the centralized meeting places where these two immense forces collide and negotiate terms.
Now, as we explore this macroeconomic engine, the academic framework introduces a categorization that I really want to push back on, or at least ask you to clarify mechanistically. It draws a stark contrast between real or economic investments and financial investments. Why create this semantic divide? Isn't buying a stock an economic investment?
It's a common point of confusion, but the distinction is vital for understanding how a national economy actually grows. Let's look at the strict definitions here. A real or economic investment involves the creation or acquisition of tangible physical assets. We're talking about pouring concrete for a new manufacturing plant, purchasing heavy machinery, or building infrastructure. The framework states that economic investments increase the current economy's capital stock, the physical goods used to produce other goods and services. It generates raw industrial activity and physical reality.
Okay, so economic investment is the physical stuff that creates jobs and builds the economy.
Exactly. Financial investments, however, involve paper contracts, stocks, bonds, derivatives. When you buy a share of stock on the secondary market from another investor, you haven't built a factory, you haven't hired a worker, you have simply transferred a paper claim of ownership from one person to another.
I see, but surely the paper is connected to the physical.
It is entirely dependent on it, and this is the key insight you must internalize for the exam. The framework dictates that financial markets exist solely as a support mechanism for the real market. The paper contracts exist only to facilitate the pooling of capital necessary to fund the massive physical projects.
So the stock market just feeds the real economy.
Right. The money you put into a financial investment, like buying shares in an initial public offering, is ultimately taken by the corporation and converted into a physical asset, like a new research laboratory. A perfect financial market is nothing more than a highly efficient mirror reflecting the progress and valuation of the real physical economy.
It connects the dots perfectly. The paper funds the physical. Now, earlier we discussed how the text views active trading as gambling. It applies a similarly strict, almost moral lens to the broader definitions of investment versus speculation.
Yeah, it relies heavily on the classic old-school value investing ethos, championed by figures like Benjamin Graham.
The framework states that an investment means money is committed with the expectation of gain only when, upon thorough analysis, there is a high degree of security for the principal amount, as well as security of return within an expected time frame.
The three pillars are absolute: thorough analysis, security of principal, and security of return. If you buy a highly rated government bond after evaluating inflation data, that is an investment.
But then it states that committing money with an expectation of gain without thorough analysis, without security of principal, and without security of return is the definition of speculation or gambling.
It leaves no gray area. If you buy a volatile cryptocurrency simply because it went up 20% yesterday and you hope someone will pay more for it tomorrow, you have performed no fundamental analysis and your principal has zero security. According to the foundational principles of finance, you are not an investor, you're a speculator.
To illustrate how all of these concepts, saving, investing, corporate financing, and economic capital formation impact a nation on a macro scale, the framework provides some staggering historical data regarding India's average savings rates over its 5-year plans. The sheer scale of the transformation is incredible.
The numbers tell the story of a developing economy hitting critical mass.
In the first 5-year plan, stretching from 1951 to 1956, the gross domestic savings rate for the entire nation was a mere 9.2%. Fast forward to the sixth plan in the 1980s, and it had climbed to 17.9%. But then we see an explosion. During the 10th plan from 2002 to 2007, it jumps to 31.3%. And in the 11th plan from 2007 to 2012, it hits an astonishing 33.7%.
Let's break down the macroeconomic mechanics of what that actually means. We established that saving money is the deferral of current consumption. Imagine an entire nation of over 1 billion people going from saving 9% of their aggregate income to saving roughly 34% of their income.
It's an unimaginably massive tidal wave of deferred capital.
And where does that tidal wave go? It doesn't just sit in mattresses. It flows directly into the financial markets. It floods into bank deposits, mutual funds, and equity markets. This massive influx of capital drives down the cost of borrowing for corporations.
Because there's so much money available to lend.
Right. Suddenly, corporate finance departments have access to cheap, abundant capital. They take that financial capital and convert it into real economic investments. They build steel mills, technology parks, telecom networks. A high domestic savings rate is the high-octane fuel required to transition from an agrarian economy to a massive industrial and technological powerhouse. The savings rate dictates the growth rate of the real economy.
It's the engine revving up. But inevitably, when you have millions of individuals interacting with these complex financial markets, critical mistakes are made. The framework outlines a specific list of common errors in investment management. And as a future professional, understanding how people fail is just as important as understanding how the math works.
Behavioral finance often overrides mathematical finance. The text isolates several critical errors. The first is having high and unrealistic expectations of returns.
Like expecting a 20% guaranteed annual return when the macroeconomy is growing at 4%. The math simply doesn't support it. The second error is linking financial planning solely to tax planning. Let's pause on the mechanics of this one. Why is that considered an error? Shouldn't minimizing taxes be a primary goal?
You should certainly optimize for taxes, but you cannot let the tax tail wag the investment dog. The error occurs when an investor makes a fundamentally poor investment decision, like buying an asset with terrible economics or massive fees simply because it offers a tax write-off. If you lose $1 in real economic value to save 30 cents in taxes, you are destroying your wealth.
Oh, okay.
The primary goal is achieving financial objectives through sound fundamental analysis. Tax efficiency is merely the secondary optimization of that process.
That makes perfect sense. The third error is operating with uncertain investment goals. The fourth is improper financial and investment planning. The fifth is a fascinating behavioral quirk, investing only in adversity.
This means the investor ignores their portfolio during boom times, letting it drift dangerously out of balance, and only pays attention or takes action when a crisis hits or the market crashes. They react out of panic rather than operating proactively.
And the final error is conducting no regular evaluation of financial plans.
If we synthesize this list, we can map it directly back to the 6-step investment process we detailed earlier. If an investor has uncertain goals, they have catastrophically failed step one, framing the policy. If they engage in improper planning, they have failed the rigorous analysis required in steps 3 and 4. And if they conduct no regular evaluation, they have completely abandoned step 6, feedback and rebalancing.
So it all ties together.
Exactly. The academic framework provides the precise mechanical blueprint for success and then explicitly lists the inevitable consequences of ignoring that blueprint.
It is a perfect closed loop. And avoiding those behavioral errors requires a deep introspective understanding of who you are as an investor, where you are in your biological timeline, and what your actual mathematical capacity for risk is.
Which serves as the perfect bridge to our final area of exploration, the human element. We're moving from the macroeconomics of national savings rates down to the psychological architecture of the individual.
The framework provides a fascinating model called the investor life cycle, which breaks down an individual's financial journey into 4 distinct biological stages of risk. It attempts to map the mathematical capacity for risk against a human lifespan. Let's look at the mechanics of these 4 stages.
The underlying variable here is time horizon.
Stage 1 is the early life career. The model notes that at the very beginning of a career, a person's net worth is virtually zero, and they are often burdened with debt from education loans. Yet, perhaps counterintuitively, it categorizes this specific stage as having the capacity for high risk and low or very low initial return, fueled by the expectation of massive returns in the distant future.
Let's explain the math behind why a broke 25-year-old is encouraged to take high risks. It's entirely about the timeline and the sequence of returns risk. When you have very little capital, a 50% loss in the stock market might hurt psychologically, but the absolute dollar amount lost is actually small.
Because 50% of $1,000 is just $500.
Right. More importantly, that 25-year-old has 40 years of future human capital, 40 years of future wages to earn, save, and invest. If their aggressive, high-risk portfolio crashes early, they have 4 decades for the compound interest curve to recover and accelerate. Their capacity to absorb mathematical volatility is at its absolute lifetime maximum.
Stage 2 is the midlife career. The model characterizes this stage by a noticeable growth in wealth and income. A solid foundational base has been built. It still encourages a high-risk, high-return mentality, but it notes the extent of the risk should moderate because the primary priority shifts to heavy capital acquisition.
You're in your peak earning years. You have a mortgage, perhaps dependents. You are accumulating massive amounts of capital. You still need aggressive growth to outpace inflation, but you can no longer afford to be reckless because the absolute dollar amounts are getting much larger and your recovery timeline is shortening.
Then we arrive at stage 3, late life career. The primary objective shifts dramatically from acquisition to capital appreciation and preservation. You have a substantial asset base. Your savings levels are at their peak because your income is high and your expenses have dropped. Crucially, the model assumes that at this stage, major debts and loans are fully repaid.
You're entering the transition zone here. The heavy lifting of wealth creation is largely complete. Now your job is to protect the purchasing power of that wealth. You begin de-risking the portfolio, slowly shifting assets away from volatile equities and towards more stable instruments.
Because that leads directly into stage 4, the retirement career. The framework paints a very stark, vulnerable picture here. This stage is dominated by unpredictable health expenses and the relentless threat of high inflation. Investment yields are now the primary, or only, source of income and sustenance. Therefore, risk must be reduced considerably, even if it guarantees low returns, because a stable, predictable income source is the absolute priority.
Let's look at the sequence of returns math for a 65-year-old retiree. If they maintain a high-risk equity portfolio and the market crashes 50% the day after they retire, it is catastrophic.
They don't have the 40 years to wait for it to bounce back.
Exactly. They no longer have wage income to rely on, which means they are forced to sell their deflated assets at the absolute bottom on the market just to buy groceries. They permanently lock in those losses and drastically increase the probability of outliving their money.
The model synthesizes this entire biological timeline into a single golden rule. The risk-taking capacity of an individual inherently diminishes with age and time. Therefore, as an individual advances in age, they must systematically shift their portfolio away from volatile equities and heavily into stable debt securities.
It is the foundational orthodoxy of life cycle investing. Diminishing time equals diminishing risk capacity.
Now, the framework doesn't just categorize individuals biologically, it also presents a highly unique, specific taxonomy classifying investors into 5 distinct behavioral personality types. The naming conventions here are idiosyncratic to the text, so if you are an MBA student, you really need to lock these specific terms into your memory. Let's analyze the characteristics of each.
These archetypes are very useful for understanding how different psychological profiles interact with the market mechanics we've discussed.
Type 1 is the common path follower. The model describes them as having a highly conservative approach, preferring low risk and low return, and being decidedly less innovative.
This is the individual who relies heavily on heuristics and herd behavior. They don't engage in deep fundamental analysis. They simply buy the standard broad market mutual fund that their employer offers and accept the average market return. They are the ultimate passive participants.
Type 2 is the unknown path follower. They operate contrary to the common trend, stepping in to buy when others sell, taking moderate risks in pursuit of moderate to high returns.
This is the classic contrarian. They look for market overreactions. If a fundamentally sound company misses an earnings estimate by a penny and the stock drops 10% due to panic, the contrarian steps in to buy the artificially discounted asset.
Type 3 is the conservative hedger. And we need to pause here because the definition provided in the text is a massive paradox. The text states that this type usually invests in a safe mode, heavily preferring government bonds and highly secure investments. However, and this is a crazy part, their behavioral expectation is a high return expectation with low risk.
I cannot emphasize enough how important the specific definition is for an exam scenario. It is a brilliant psychological trap.
Let's explain why that is.
We spent this entire deep dive establishing the absolute bedrock rule of finance, the risk-return trade-off. Mathematically, low risk guarantees low return. High risk is required for the probability of high return, but the framework explicitly states that the conservative hedger expects the mathematical impossible. They demand absolute safety of principal in a government bond, yet somehow expect that bond to yield a massive high-risk style return.
So they're delusional.
Basically, yes. It highlights a severe behavioral flaw, a complete detachment from financial reality. If you face a scenario on a test describing an investor demanding high returns from a risk-free asset, you are looking at the conservative hedger. Do not let your knowledge of how the math should work override the text description of how this individual thinks.
That is a phenomenal insight. Moving on, type 4 is the calculated risk taker.
Yeah.
They engage in regular investments, utilize a hybrid of multiple securities rather than a single asset class, and frequently rebalance their portfolios.
This archetype represents the framework's ideal rational actor. They are effectively executing the 6-step investment process. They practice proper asset allocation, they diversify, and they mathematically rebalance to manage risk.
Finally, type 5 is the competitor. They invest early, they commit maximum available capital into their investments, and they exhibit extremely high confidence regarding future investment scenarios.
They're aggressive, highly convicted, and rely heavily on their own fundamental or technical analysis to take concentrated high-risk positions. So just to recap for your notes, you have the common path follower, the unknown path contrarian, the paradoxical conservative hedger, the rational calculated risk taker, and the aggressive competitor.
If the conservative hedger expecting high returns from low risk was a psychological trap, the framework presents another matrix that is equally counterintuitive. It maps the structural expectations of investors based purely on their income groups categorized as high, medium, and low. It charts their behavioral expectations for return, risk, and tax benefits. Let's look at the mechanics of this matrix.
This is another instance where you must memorize the framework's specific logic because it totally subverts common assumptions about wealth and risk.
According to the matrix, the high income group expects high returns, but they actively take low W risk, and they seek nil or negligible tax benefits from these specific investment structures.
Let's contrast that with the other end of the spectrum before we unpack it.
The low-income group also expects high returns, but the matrix states they take IGH risk, and they expect maximum tax benefits.
I have to push back on the logic here. The orthodox assumption is that a high-income individual has vast disposable capital. If they lose a bet, it doesn't hurt their standard of living. Therefore, they should be the ones taking massive risks in volatile equities or startups.
Right, that's what you'd think.
Meanwhile, a low-income earner has precious little capital. A single loss could be devastating. Shouldn't they be hiding in low-risk, secure bonds to protect what little they have? Why does the framework state that the wealthy take low risk and the poor take high risk? It is a profound behavioral paradox, but the logic of the framework is deeply rooted in the psychology of the investor's ultimate objective. Let's analyze the high-income individual. They have already won the economic game. They have amassed significant wealth. Their primary psychological and mathematical objective shifts from wealth accumulation to wealth preservation. They do not need to take a massive, concentrated risk on a speculative tech stock to change their lifestyle. They just need a steady, low-risk return to outpace inflation and maintain their elite status quo. They play defense.
Okay, so the rich are defending the castle. What about the low-income earner?
The low-income earner is looking at the mathematics of their situation and realizing that a safe, low-risk return of 4% on a tiny amount of capital will never fundamentally change their socioeconomic status. It won't buy a house, it won't fund a retirement. Therefore, out of a perceived necessity for rapid exponential growth, they are behaviorally driven to embrace high risk. Yeah, they take concentrated debts on highly volatile assets like speculative options or high-risk equities because they feel a massive outsized return is the only mechanism available to escape their current income bracket. They are throwing Hail Mary passes because slowly running the ball just won't win the game.
That structural psychology makes complete sense when you frame it like that. The wealthy optimize for survival, the poor optimize for a breakout. And regarding the tax expectations, the matrix suggests high-income earners seek negligible benefits from these basic investments, likely because they utilize entirely separate, highly complex corporate structures and trusts for tax avoidance. Meanwhile, the lower and middle-income groups must squeeze every ounce of maximum tax benefit out of their standard retail investments just to preserve their limited capital. It's imperative to remember this specific matrix. High income correlates to low risk, low income correlates to high risk.
It's a brilliant distillation of how capital dictates behavior.
To round out this comprehensive view of the financial landscape, the framework concludes by offering a rapid-fire toolkit. It lists the core guidelines for investment decisions and identifies specific, real-world sources of information utilized in the Indian financial markets.
These guidelines are effectively the summary commandments of everything we have discussed today.
The guidelines are straightforward but foundational. Diversification must be the key word. An investor must maintain adequate life insurance cover and a liquid cash reserve before exposing capital to the markets. You must start early and save regularly to capture the mathematics of compound interest. You should avail yourself of maximum tax benefits where legally possible. And crucially, tying back to our 6-step process, you must revise and review your investments periodically.
And to conduct the fundamental analysis necessary for that review, the text grounds the academic theory by pointing students toward the actual tools of the trade.
It specifically highlights publications like Business India, Business Standard, Business Today, Business World, Financial Express, and the Economic Times. It points to the Bombay Stock Exchange official directory and analytical platforms like India Infoline and Value Notes. If an exam question presents a scenario asking an analyst where to source fundamental macroeconomic data or corporate disclosures within the Indian context, those are the definitive answers. It bridges the gap between the theoretical classroom and the physical trading desk.
We have covered an immense amount of ground. To the MBA student listening right now, you have just conceptually mastered the foundational unit of your curriculum. We have traced the flow of capital from the legal molecular definition of a single fungible security. We analyzed the complex mathematical architecture required to manage a diversified portfolio and enforce disciplined rebalancing. We zoomed out to understand how a nation's collective savings rate dictates the macroeconomic growth of its industrial base. And finally, we zoomed all the way back in to dissect the psychological paradoxes of the human beings actually making these trades. You are now equipped with the precise mechanics, the vocabulary, and the structural logic required to navigate this framework. But as we conclude, I want to leave you with an analytical perspective to carry forward. Your upcoming exam will require you to regurgitate these orthodox models perfectly. You must remember that the text rigidly equates active management with gambling, and that low-income earners seek high risk. You must prove you know the rules. But the reality of the global financial market is endlessly fluid and deeply chaotic. The true value of your MBA is not just memorizing the baseline models, but understanding their limitations. You are learning the structural orthodoxy today so that tomorrow, when the market inevitably breaks these rules, you'll be one of the few professionals who actually understands why.
That is the ultimate goal. Mastery of the rules allows you to navigate the chaos. And to leave you with one final provocative thought to mull over as you organize your notes. The framework gave us a very clean biological thumb rule. It stated that an investor's risk capacity automatically diminishes with age, and that entering retirement mandates a massive shift into safe, fixed-income debt to protect capital. But look at the modern reality. Lifespans are drastically increasing. Our retirement today could easily last 30 or 40 years. In an era where sudden bursts of inflation can completely eradicate the purchasing power of fixed income assets,
Mm.
is adhering to the traditional orthodoxy and shifting entirely to safe debt in retirement actually the most mathematically dangerous high-risk move an investor could possibly make?
It is a profound systemic contradiction that the next generation of financial architects, the people listening right now, will have to solve.
Keep questioning the models. Trust the depth of your preparation, and best of luck conquering your exams. We will see you on the next deep dive.